Jim Diller is a member of the DC chapter. He'll be our speaker tonight. He's going to speak on M&A, the corporate development process. Jim is a CFA and the founder of Longview Capital Advisors. He has 20 odd years of M&A experience, mainly in the hotel industry. Was the head of corporate development at Choice Hotels. Prior to that, he did extensive M&A work in various positions at Marriott. For the last couple of years, he's been building his own practice, Longview. Most recently, he advised Choice Hotels in their $675 million acquisition of Radisson. Check the invite out for any more details on Jim and his contact coordinates. And at this point, I'll turn it over to Jim.
All right. Well, good evening, everyone. I'm just going to try to share my screen and or just make sure that everything looks okay on your end before I get started.
Looks good.
Okay. Great. Well, thanks for the introduction, Art, and really excited to be presenting to the FANG today. I think I've been a member since 2012. As Art mentioned, I've spent my 30-year finance career entirely in the DC area with 3 industry-leading companies. And Art's given a good background. My first M&A job was back in 1999 with a PE company called Chemonics International as a government contractor here in the DC area. I worked with the CEO and 2 PE investors to lead that company's corporate development efforts. Then, as Art mentioned, in 2004, I went to Marriott International and I spent 12 years there in a wide range of finance roles, from corporate finance to real estate transactions. And I'd say from around 2006 to 2015, I was the go-to finance resource on most of our M&A deals. And I was lucky to be at the right place at the right time there in 2015 when we began merger talks with Starwood Hotels. I ran the long-range planning process for the company that year, and I owned the corporate model. So I was well situated to be the engineer of the merger model and guide Arne Sorensen, the CEO at the time, and other senior leaders in our negotiations. And then in 2016, I was recruited over to Choice Hotels. I served in 2 leadership roles there, principally as the head of M&A. I also served as the interim head of real estate investment and asset management for a bit. Those 2 teams evaluated upwards of 50 opportunities while I was there. And in 2017, I led negotiations with Brookfield Asset Management to close the Woodspring deal that Art mentioned. One thing I just wanted to say about these 3 DC employers, I was fortunate enough to work with them, for long periods in my career, and all of them have a shared common objective, which, I learned tremendously from, and that is to invest for the long term with a margin of safety in order to achieve a meaningful spread of expected returns over their costs of capital. And that's where the name of my company originates, Longview Capital Advisors. I help clients to make disciplined long-term investment decisions to drive growth and sustainable long-term growth and profitability. Just a couple of quick notes before we jump in. Any examples that I share here with you today is publicly available information, so nothing herein is confidential. And anybody who's interested in the slides afterwards, just feel free to get in touch with me. I'll make them available. Just contact me at my LinkedIn or my email below. So let's get started. Okay. So as the head of corporate development, you work as a close partner to the CEO, the board, key extended leadership team members, advising senior leadership on all manner of corporate investments. from strategic finance projects to complex financial questions. The mandate of the corporate development organization is all about driving growth and increasing shareholder value. At the same time, you need to do that while minimizing enterprise risk. So the drivers of success for a corporate development team kind of fall into two categories. Let's call one financial returns and the other risk mitigation. Excuse me. So on financial returns, it's pretty straightforward. You offer a purchase price and a set of deal terms that drive investment returns that exceed your risk-adjusted cost of capital and or drive EPS accretion. But it's more than an exercise in financial analysis. You have a lot of different areas that you need to cover yourself when you're doing an M&A deal, and you achieve that through a variety of things. It's the deal structure, there are treasury considerations, there's the legal documentation of the deal, and then there's various commercial arrangements, which I'll get into in the following slides. So who works on a corporate development team? What skill set do the corp dev team members have? Obviously, complex financial modeling and analysis, extensive experience structuring business deals, and of course, negotiating skills. But another skill, which is just important, but often overlooked, is the ability to drive organizational alignment. And I'll touch on that a lot in this presentation. Just working your way around the wheel here in a clockwise fashion. Sometimes corporate development is called upon to support large or complex corporate investments and drive organic growth. Maybe you're investing to scale up or investing in enhanced capabilities like technology or launching a new brand. Sometimes you're called upon to restructure previous deals that have either gone off the track or simply gotten stale because the terms no longer suit the current circumstances. These might include strategic partnerships, trademark license agreements. In my industry, in the lodging industry, we have a lot of franchisees. So you might have a multi-unit franchise agreement with a key owner that you need to revisit. And then just a little bit more about the lodging industry. Many of you may know, and some may not. When you think about Marriott and Hilton and Choice, these companies over the last 30 years have changed significantly and become asset-light businesses. They own very little real estate. They have very high returns on invested capital, very high EBITDA margins, and generate significant cash flow. The business models are tremendous because they generate so much cash flow that not only do you have plenty of cash to reinvest in the business and invest in organic growth, but you have a lot of cash left over for dividends and share repurchases. So these brands use their balance sheets occasionally to drive growth. So they're typically asset light. They don't need to use a lot of capital to obtain a new franchise agreement or a management agreement. But in the case of a new brand where let's say Marriott wants to establish critical mass before they can entice owners to sign franchise and management agreements, they might use their balance sheet to establish critical mass and actually invest in the real estate. Or key locations. There were key locations in New York or Chicago where we would actually buy an asset and convert it, or even buy the dirt and develop it, and use our balance sheet, either in the form of a joint venture or a senior loan or a mezz loan. Sometimes if we had to, it's definitely not our preference, we would enter into leases or guarantees. So anyway, continuing on around the wheel here clockwise, sometimes the corp dev team is called upon for analytics supporting capital allocation decisions. So where's our capital needed most in the business? What's the highest return we can get on our capital right now? What drives the most shareholder value? And this is pretty intuitive for a lot of you, as CFOs. after we satisfy our maintenance CapEx, should we deploy our capital to growth CapEx or do an M&A deal or return capital to shareholders through share repurchases or dividends? All these need to be weighed against various metrics like NPV and EPS, return on invested capital, investment capacity. And so the corporate development team skill set comes in to play and is helpful to senior management for those questions. And then you just have oddballs that come across your desk, like investments in tax credit deals or secondarily liable guarantees. Like at Marriott, we had spun off Sunrise Senior Living many, many years ago, but still had a relationship with them where we were secondarily liable under a guarantee. So focusing on the M&A circle, when it comes to M&A deals, we tend to see headlines that focus on negotiations and deal making. But M&A is much more than that. It's usually a very lengthy and careful research project that requires you to align multiple stakeholders and advisors. It's also a very careful relationship project. It's really a delicate dance with the seller's management and the ownership of the target. I mean, at the heart of the process, you're looking at buying an entire business and an entire team with potentially hundreds or even thousands of employees. So, yeah, think about your own business. You have products or services, you have customers, employees, vendors, contracts, IT systems, tangible assets, intangible assets like brands, real estate potentially, contractual obligations, financial liabilities, maybe even lawsuits. So the core group of key decision makers in your organization will ultimately need to get on the same page, meaning you, the CEO, your board, your line leaders, possibly your shareholders if the transaction's big enough. And you'll need to engage a group, sometimes a large group of your employees, to evaluate the target company's business, its strengths, weaknesses, opportunities, threats, and its employees. And if it's a large enough deal, you'll likely need to engage a team of outside advisors to help, uh, evaluate and process reams and reams of data that the target puts up in a data room on its financial accounting, tax, and legal matters. You might hire an M&A advisor or an investment banker to help navigate the process and navigate the relationship with the seller and their banker. And then just again going around the wheel clockwise, other stakeholders that you will have to keep in mind, especially if it's a significant deal or if you're a public company. Rating agencies, does this deal impact my credit rating? What's the impact on our leverage ratio? How long is it going to take us to return to our target ratio after we, take on some debt to finance this deal? Auditors are obvious constituent. If the deal's large enough, you may encounter Regulation SX and be required to file the target company's audited financial statements. And then there's regulators, Hart-Scott-Rodino, and we'll defer to Art maybe in the last section on what the thresholds are. But I believe that any deal above about $445 million needs HSR approval. And depending on the size of the buyer or the seller, it might even need it at about 111 million. I don't know, Art, did I get that right? Or does that sound about right? It could be updated also.
Yeah, the number's lower. The number's a lot lower.
It's gotten a lot lower.
Yeah.
So that's regulatory, and then shareholders. If you're talking about a merger, it may require a majority vote of your shareholders. If you're issuing like more than 20% of your own stock in a merger, you'll have to get your shareholders to approve the deal. So, there's a lot of considerations in an M&A deal, a lot of preoccupation for a CEO and a corporate development team. I mean, sometimes it's like herding cats, at least for the head of corporate development. And for the CEO, sometimes it's like, a large group therapy session. Um, but this alignment internally and with external constituents is a big job, and it requires careful relationship management. And you also have to appreciate that on your team. If you look through all these internal groups here, you go down through the list. It's not just your functional team, your legal, tax, FP&A, treasury, and accounting group, but it's operations and sales and IT, and they have day jobs and deals. They're fun to work on, but they take up a lot of time. So you have to be careful how and when you engage, your business to help evaluate these deals. So, I've learned some best practices over the years when it comes to alignment. And I would say, listen to and educate your internal stakeholders, bring business and functional leaders in early, and work carefully to align any conflicting organizational objectives. See, people need to, they need to see the greater good of the deal and commit along the way. Don't surprise the organization's leaders right before you announce the deal to the world. That usually doesn't end well. And then just another note on, when or even if to bring in certain advisors. There are plenty of small deals where you may not even need outside advisors. You probably need an M&A lawyer because papering deals is typically outside the scope of a legal team. But some small deals you won't need an investment banker or need outside accounting and finance advisors. But as the deals grow, as they get bigger, you probably will engage these firms. And then the question is when to engage them. If you engage an investment banker, they're really with you through the entire process. So you bring them early and bring them in first. You're not likely to spend a lot of money on due diligence until it gets serious and you're close to an agreement with the seller on purchase price and deal structure. But if you are and you get into that confirmatory phase, then you want to bring in an M&A lawyer. You get started on drafting a purchase and sale agreement. You'll bring in an accounting firm to do the heart of the financial due diligence, and a tax firm, which is often the same. The accounting and the tax DD is often done by the same advisor. You might need to bring in a PR firm if it's a large public deal, and your internal communications team needs support. And then the last thing I'll say about this slide is, how do you select the right advisors? Well, it depends on the transaction. So if just speaking with regard to investment bankers, you may need a larger bank with a balance sheet if you have a deal where you need to get financing. So maybe like a Goldman Sachs or JP Morgan, who can provide financing. Some banks, maybe like smaller boutique banks, Lazard or Moelis and Company, they don't have balance sheets, but they might have more targeted experience with specific sectors or specific situations. Some advisors are uh, highly experienced with real estate transactions. Other advisors are more experienced in software. Also, some banks will participate in financing you. So if you have a revolver, some of your banks might be in there and providing financing with the understanding that they'll get consideration for M&A mandates. And then finally, the other thing you need to do when you're selecting these advisors is clear conflicts. You'll need to make sure that obviously they're not working with the seller, and they're not working with any other competitors of yours on that deal. So this next slide is all about the deal pipeline. So every CEO and corp dev team has a deal pipeline. It's basically a list of companies in your industry that are potential acquisition targets or merger candidates, or maybe they're just strategic partners. On the M&A side, these could be, bolt-on opportunities, tuck-in opportunities, or large transformational deals. Usually they're friendly. Occasionally they can get hostile. But this pipeline is a map of all the pieces of a large industry puzzle. You could kind of think of it as a range of strategic moves on an industry chessboard. So, for example, what if we acquire company A? Will we have the capacity to buy company B if it becomes available? Especially if what we really want is company B, can we afford to take on that opportunity cost of A? What if we don't acquire company A? Maybe we think it's too expensive, but then our competitor does. Can we afford to let that happen? And then at a certain price, everybody kind of looks himself in the mirror and says, well, at a certain price, would we consider being a target and selling the company? So at any given time, the corporate development group and the CEO could be tracking 25 plus opportunities. Most are wish list items, and you have no idea if the owners are really ready to sell. Some targets are on the list and may actually be casually in the market, but occasionally a company will be on the list and it becomes ripe and actionable. So what does that mean? So, they've hired an advisor, they have a teaser document, or maybe even have a full-blown SIM, which stands for confidential information memorandum, and they might be ready to have preliminary discussions. So how do you come up with this list of companies in a pipeline, and how do you find out if a company is ripe and actionable and ready to talk? It happens at a variety of levels. You typically, at Choice, I had a dozen investment banking partners that I was in touch with regularly. They're excellent sources of ideas and even free analysis, before you get into the heart of a deal, and they kind of know who's in the marketplace and who's thinking of selling. Heads of corporate development like myself network with our peers, and then another key source of these deals in the pipeline comes at the CEO level. So there's a lot of peer-to-peer conversations that happen at the CEO level with companies in their industry. And then finally, even within a company, you have division leaders like heads of operations who know their competitors and know, what companies out there could be additive or could be interesting as far as maybe like a tuck-in kind of an opportunity. So lots of different ways to come up with this list. So then moving over to the right side here, all target company candidates go through a vetting process. So, just kind of working your way down from the top of this funnel. The first is obviously strategic fit. Does it drive growth? Is it aligned with our corporate strategy? Does it complement our core business or complicate our core business? Will it enhance or expand our capabilities? Then financial returns, obviously. Is it accretive? Does it drive returns above our cost of capital? Do we have some special know-how that would allow us to enhance the returns? What impact will the deal have on our borrowing capacity? And then quality is an important one. Does the business have an economic moat? How strong is the management team? And at the bottom is the million-dollar question. Is it even for sale? Will the counterparty transact in the near term? Like I said, bankers are helpful in having an awareness of candidates that are nearing sale. Sometimes you might, be proactive and, engage in those conversations to preempt, any auctions that the seller might launch. It ideally starts at the top of the funnel with the question, would this be a strategic fit? So you go through your 25 ideas and say, is this a strategic fit? But sometimes things drop in your lap, like they start at the bottom of the funnel and they become available. And you say, gee, this is available, is it worthwhile? Should I take a look at it? And other deals come in at the middle of the funnel as financial deals. Sometimes companies are motivated to sell for whatever reason, at a price below what the business is worth. I mean, companies sell for lots of different reasons. Some are planned and some are unplanned. And some of the unplanned circumstances that force a business into the market cause them to have some urgency and to be ready to sell at an attractive price. At that point, you have to ask yourself, well, maybe it's not even that strategic, but it would increase shareholder value. I mean, if I can buy a dollar for 75 cents, maybe I should do that. And it's funny, this whole question of strategic versus financial deal. I've seen multiple deals that started out as financial deals and turned into strategic deals. Starwood is a perfect example. For years, we looked at them on the list because they were our chief competitor. It always seemed like a 2 + 2 = 4 kind of an equation. We never were serious about Starwood at all. In 2015, because of a misstep on their part with strategy, they fired their CEO and took the company to market. They gave us an opportunity to look at it in April. We took a quick look at it and said, no, it's 2 + 2 = 4. Yeah, they kept pinging us over the summer, and by August, we had more confidential information, and we looked at it again in August and said, no, it's still at this price, given the ratio of the two stock prices, it really doesn't drive that much value. But over a period of 7 weeks, from September on, it became more and more attractive. Their stock price fell, ours stayed put. The ratio came down where it became a very interesting financial deal. So we started looking at it, and then we realized once we got into the nuts and bolts that there was a much bigger story here, that there were scale benefits. It was definitely strategic in nature. And so even after a Chinese bidder came in and bid us up, we decided to raise our price because we really believed in the strategic merits of the deal. So all that to say, all the stars have to be
Jim, do you want
aligned.
questions on the fly, or should we wait till the end? I had two on that.
Yeah, let's wait till the end. I have a lot of material. I want to make sure we get through it, all the slides, but definitely we'll have opportunity at the end for questions.
Your call.
So as you can see, all the stars have to be aligned. It's rare to find high quality actionable opportunities. And among high quality actionable opportunities, it's even more rare to agree on price and deal terms with the seller and actually make it to closing. I'll just give you a quick example. When I was at Marriott, we were in conversations with CSX to buy the Greenbrier Resort in West Virginia. It was CSX's last non-core asset that they were divesting of to become a pure play rail company. They had a very onerous labor agreement. They were losing money. I can't remember how many $1 million a month they were actually losing at the Greenbrier Resort, but they needed a buyer urgently. They negotiated with Marriott to sell the Greenbrier Resort to Marriott. We even signed definitive purchase agreements with Greenbrier. And then a local businessman came in and he offered a lot more. And the deal disappeared. It got taken away from us. And so even if you make it all the way through the process, sometimes things will come off the rails, so to speak, no pun intended. Also, just with regard to that last slide, you'll look at probably 50 to 100 opportunities for every one deal that you complete. So this is one of a couple slides that I'll show on the transaction process. And this is kind of my overview. It's a graphic that shows the key milestones and phases that an M&A transaction goes through. I'll go through more detail on confirmatory diligence in the next slide, but there's a gradual progression that you go through as you go from the left to the right. You gradually increase in scope and cadence and resources as you get towards definitive agreements and closing a deal. Usually the team starts off small, as a small circle of executives. It's a CEO, the CFO, the corp dev team, an M&A person in your legal team, the head of tax. And you keep the team small for a couple of reasons. Number one, confidentiality is paramount with these deals. So minimizing any leaks is super important. But you also have to keep your line leaders focused on the core business, and you have to try hard not to distract them. So there's a lot of work that gets done during the preliminary review and making this indicative offer before you engage the wider organization. But once a buyer and seller are close on purchase price in general terms, then the seller gives you more and more access to confidential information, and then you need to broaden out your team. So you bring in your business leaders and you bring in your heads of functional areas, but you're still trying to keep the internal team relatively small. At that point, if it's big enough, you're bringing in outside advisors, M&A lawyers, finance and accounting advisors. I'll get into reps and warranties insurance on another slide, but that's a product that's becoming more and more prevalent to reduce risk for M&A deals. And so if that's the case, you'll have a reps and warranties insurance broker, and you'll need to bring them in on the team. So all these advisors cost money. And I'll talk about this in a bit, but buyers typically don't like to spend a lot of money on advisors until they're more and more confident that the deal is actually going to happen and that we're going to get on the same page with regard to price and deal terms with the seller. Like I've said, at any point along this timeline, a deal can evaporate and go off the rails like the Greenbrier Resort did. And then on the bottom half of here is about board alignment, and that's key all along the timeline, all along the process. You want to keep them informed, get their feedback, get their guidance, and expect them to focus on a handful of key questions that boards focus on. How's this deal going to change our position in the industry? Hopefully it'll enhance our core business, bring new capabilities, customers, geographies, better technology. The board will want comfort that doing this deal isn't going to jeopardize our core business. Obviously focus on attractive financial returns, and then risk mitigate. How management are you going to mitigate risks, operational risks, financial risks, legal risks, and then there's opportunity costs. So just a couple of best practices here again. Stay aligned with the board and engage the business early on, engage corporate functions early on. What doesn't work is complete secrecy. As much as you want to keep a deal under wraps, not let it get out, not let your team get distracted. You never want to spring the deal on your team at the last minute. So it's a careful balance between confidentiality and engagement. Confidentiality is paramount. I mean, especially with public deals, you've got SEC considerations, you've got public shareholders, insider trading concerns, and you also don't want to put the target into play and encourage competition. But you do need your team, and you need them in increasing numbers as you go through this timeline. So you want to keep the deal team small, but you want to keep it well represented. So this is another view of the process. It demonstrates the path of a transaction through the lens of the documents that are traded between the parties. And this is by no means an exhaustive list of documents, but it's kind of a simple jumping off point for understanding the evolving relationship between a buyer and a seller. And it just shows the key phases, which I've broken down here into early phase, confirmatory, and later in the process. So early in stage, again, this is just a general flow of conversations and documents. Two parties will sign an NDA to start sharing confidential information. Often, if a seller is engaged with multiple buyers, their banker will prepare a SIM. Again, it stands for Confidential Information Memorandum. And a SIM provides, enough detail for the buyers to put together kind of a high level bid. It includes key stats and KPIs of the business. They'll provide high level financial statements, historical financial statements. They might provide management's budgets and pro forma financials for 3 to 5 years. They might provide high level information on the organization, but they're not going to provide any, employee data and compensation, no customer lists. And then another document here is the process letter. A seller's banker might provide a price. If it's an auction, they're going to provide you with a process letter that shows, what are the key dates? When are the initial bids due? What are the instructions for accessing the data room? And then key elements required for the indicative offer that you give by the due date. So, what's the purchase price? What form of consideration? Is it stock versus cash? What's the transaction perimeter? What's in and what's not in? What are you not buying? What valuation methodology are you using? What's the buyer's strategic rationale for doing this deal? How's the buyer going to finance it? Will the buyer need to obtain financing? So this first stage here is really the first look under the hood phase. And, the seller shares enough information in the sim for the buyer to make a high level valuation assessment and formulate a non-binding offer. And then, and going down to the middle section, if the buyer's non-binding offer is accessible, and that can be rare, most deals die in this early stage. I'd say most deals die because buyer and seller can't agree on price. Sometimes there's other key deal terms that they can't get aligned on, but you might do 10 of these and one of them will get to a confirmatory where you're on the same page. So if the buyer's non-binding offer is accepted, then the seller's going to provide a lot more detailed information in the data room. So full audited financial statements with notes, detailed tax returns, tax audits, IRS tax rulings, full org charts with responsibilities. I'd say they provide some customer details, probably without names and not detailed contracts yet. They might provide some details of litigation. So sellers are in kind of the same progression as buyers are. They, both parties are getting comfortable with each other as you go through the process. And just like the seller's unwilling to spend a lot of money doing due diligence until they're confident, the seller might not be willing to share confidential details until later when they're confident the deal is going to go through. So like the employee payroll data tape or a complete list of customer contracts with full contract details. Usually the seller, holds that back until the end. A key thing that usually happens during this phase is a management presentation. So it's several hours to a half of a day, conducted off-site, where the target company management makes its CEO, CFO, COO, and some other heads of like marketing, sales, and IT and HR available to the buyer. So the CEO, CFO, and corp dev, head of corp dev might attend this presentation. It's usually conducted off-site to keep it confidential from the seller's employees because they're even more sensitive than the buyer to tipping their employees that their company's about ready to get sold. And it just allows the buyer to ask questions directly of management. There might even be site visits, certain properties or certain, business operations that might be part of the management presentation. So after you go through all that and you get all this information, from the data room and the management presentation, now the buyer has a lot of info to process and a lot of wood to chop. And that at that point, you're really broadening out this effort to your entire organization. Again, you're still trying to keep it confidential and you're limiting the knowledge of the deal to your business leads and your functional leaders. But after that management presentation, there's a lot to do. So you want to schedule breakout sessions, like multiple breakout sessions with the target company's operations and their functional units. So you'll have, your head of your COO, have a breakout session with the head of operations. The heads of sales, the heads of marketing, technology, HR, legal, and finance and accounting. All of these groups will have an opportunity to meet, for say like a 40-minute session with their counterparts. Again, you're evaluating an entire business and an entire team of employees. And once you've studied up and gotten a lot smarter on the business, you then have the ability to put together a binding offer. And you as the buyer might make some price adjustments from what you did in the indication of interest. You might have identified additional costs and liabilities during due diligence, or might put certain conditions in place to guard against some risks that you discovered during due diligence. And then down here in the final phase, if the parties are agreed on the price and the structure and all the key deal terms, then it's a sprint to the finish line to negotiate the definitive agreements. The principal document of definitive agreements is the purchase and sale agreement. And that actually, drafting of that actually usually starts at the beginning of confirmatory. It's just there's so much work to be done on the PSA, many clauses and provisions to negotiate. So that is a work stream that you probably do have to spend money on before you start, spending money on other areas. But once you've gotten past confirmatory, then the legal team is really highly engaged with your outside counsel. There's just a lot of clauses and provisions to negotiate there. Other key documents and processes that come into play here. You'll probably have a transition services agreement. I'll touch on that a little bit more in the next slide. Like we talked about, you may have a regulatory filing to do as well. And then if it's a merger and you're putting proxy materials together, you might need shareholder approval. I think it's if you as the buyer are issuing 20% of your stock or more. I think this is NYSE and NASDAQ requirements. At that point, you'll be required to get a majority vote of your shareholders. So then diving just a little deeper into the confirmatory part of that last slide, this is kind of like the core work streams and deliverables that you would go through in confirmatory. It's a matrix of the process by discipline, but it's not linear. These work streams run in parallel. I will say the corporate development function is usually the first one in and the last one out. Most of these diligence exercises have revenue and cost implications, within each function and with each business unit that, you're evaluating revenue and costs. And so naturally, all that feeds back to the corporate development team. Then Corp Dev creates and continually adjusts cash flow projections of the target and your valuation. So you think of corporate development here on the left as the hub of the spokes. They gather and summarize the detailed research and translate all the pieces of the business into cash flow projections and a return analysis. And then we develop recommendations for the CEO and for the board on purchase price and structure. The next column over, operations, IT, sales, and marketing. These teams are tasked with evaluating the heart of the business. So, evaluating the target company's capabilities, reviewing key contracts, looking at the technology roadmap. IT systems are super critical, at least in any M&A deal I've worked on. IT systems are a key focus and can be a key risk. So how compatible is their IT system with ours? How much time and how much money is it going to take to integrate with ours? In the middle there, finance and accounting. The quality of earnings report is a big preoccupation with the finance and accounting side of the diligence. So what is Q of E? So Q of E is over and above audited financial statements. Audits and reviews demonstrate good financial performance and compliance with GAAP. And the Q of E report complements the statements. They're more analytical and more forward-looking. The Q of E provides a detailed analysis of the company's revenue, expenses, and earnings, but it goes a step further and looks at normalized earnings. So the result of adjustments and add backs for non-recurring things such as legal fees associated with a one-time lawsuit or a loss, losses from a discontinued product line. So all of these boil down to an EBITDA number, which is usually the basis for negotiations of purchase price. Often, even though you're looking at what's my IRR, what's my NPV, what's my EPS, usually the price negotiation hinges around some multiple of EBITDA. So that's the key number that you're trying to get to through quality of earnings. Q of E report will also include an evaluation of debt and debt-like items. That'll be a purchase price adjustment. And then Q of E will also provide an understanding of how much working capital is needed to run the business, which involves setting a normalized working capital target and then defining a working capital adjustment mechanism, again, a purchase price adjustment. Last one there, fairness opinion, especially for public company deals. You might need to bring in an investment bank or a third-party accounting firm to do an independent valuation. Basically demonstrates that the board is exercising their fiduciary duty and helps protect against shareholder litigation. On the HR front, it's a large and delicate exercise of retaining target companies' key employees, their change of control provisions, and single or double trigger acceleration of options and restricted stock units. Transition services agreement, which I mentioned before, that's an agreement whereby the seller agrees to continue providing services to the buyer, say for like 6 to 18 months after closing, to ensure a smooth transition of the business over to the buyer. And then last but not least is legal. Again, legal starts early with drafting of the purchase and sale agreement, but they're also burdened along with outside legal advisors to diligence, the legal side of the business, compliance with laws and regulations, review of key contracts, evaluating any lawsuits or litigation risk, evaluating intellectual property for infringement rights. And then when it comes to the PSA, that, as I mentioned before, is a lengthy document. Key provisions of a PSA are covenants, conditions to closing, and reps and warranties. So covenants are things like, the target company covenants to do or refrain from doing anything between signing and closing. Conditions to close might include regulatory approvals or, the absence of any material adverse effects. And then reps and warranties. A rep is a statement of fact. For example, like the assets are in good standing or the inventory is saleable. Warranties are an assurance. We assure that we will operate the business in normal course between signing and closing. So these reps and warranties are a big deal. Traditionally, the seller agrees to indemnify the buyer for any breaches in the seller's reps and warranties. In the past, that would be done through some kind of an escrow, maybe 10 or 15% of the purchase price. But that's a sticky negotiation. And more in the last years, reps and warranties insurance is a good alternative. So basically, the insurance company backs the risk of the seller breaching a rep or a warranty. An example of a policy might be, you might have a $20 million deal and the policy coverage limit is 10% of the purchase price or $2 million. Then the insurance company will charge a premium of 2 to 3% of that coverage limit. Then there'll be some retention or deductible that's equal to about 1% of the purchase price. Then going back to due diligence and the team, this reps and warranties insurance product is becoming more and more prevalent. So I think it's fair to say the buyer needs to be aware of it and get comfortable with it because many sellers will require it. So once you know that reps and warranties policy is going to be part of the deal, then you need to add an insurance broker to the team, and they'll help coordinate the drafting of the PSA and the due diligence from the reps and warranties insurance perspective. So what's the ultimate goal here for all this? Increasing shareholder value. And this is really at the heart of the corporate development preoccupation, and it's also part of the Treasury mandate too. You spend a lot of time summarizing cash flow projections. Maybe there's some synergies, cost synergies or revenue synergies. You're usually putting together 10 years of cash flows with a terminal value. And then the objective is to come up with purchase price, form of consideration, and deal structure that drives returns above our cost of capital. If it's a steady state business, maybe that's just looking at normalized return on invested capital for the last 12 months or for forward 12. If you need to capture the value of the growth over time, you're probably looking at NPV or IRR. As I said before, public companies are also going to be concerned with EPS accretion. And then from the Treasury standpoint, there's a financing question. What's the impact of the deal on our balance sheet? How will we continue to finance our maintenance CapEx and maybe our growth CapEx of our own business and do this deal at the same time? And how long is it going to take us to pay down debt? What's the impact on our credit rating? How long is it going to take us to get back to our target ratio? And then, finally, if stock's part of the consideration, there's going to be shareholder dilution. So, and if we're buying back shares after this deal, how long is it going to take to, reduce the impact of shareholder dilution? So these are important considerations to keep in mind for the board: opportunity, costs, and capacity. Your board is going to evaluate an opportunity based on the value to the enterprise and the risk to the enterprise. So I'll just read through these, the investment capacity, mind share, and human capital. Obviously, large deals can crowd out organic growth investments. Any deal, especially a big deal, can and will distract senior management's attention from the core business. So that's an important opportunity cost to consider. And then you also have to realize that the diligence and then the integration after closing places significant demands on corporate functions and field employees. So, and we're getting towards the end of my slides here, but talking about the board, here is a set of key value drivers that boards keep in mind when they're evaluating these opportunities. And I have a section for the buyer and a section for the seller. So the first boxes in each column here are related to each other. So on the buyer side, and let's just assume we're a strategic buyer and not a PE firm or a financial buyer, but you're an operating business, you have the opportunity to eliminate redundant overhead. You might have the opportunity to build scale. So you likely will have some synergies, likely will have some cost synergies. You might have some revenue synergies. And, if it's large enough, it might bring you scale and bring you other benefits. And so the seller, in evaluating potential buyers, will ask themselves, is this a strategic buyer or a financial buyer? Because the seller knows that a strategic buyer has more value that they can play with in terms of putting together an offer and a purchase price. So they may actually prefer the strategic buyer because they, basically this question of who gets the value of the synergies is always a hotly negotiated item between, the seller and the strategic buyer. On the buyer side, other considerations. Is this going to bring faster growth, bring new capabilities, new geographies? Is buying more efficient than building? For us, is this a strategic deal or is it purely a financial deal, like I talked about earlier? And the bottom line here is risk-adjusted returns. For the seller, there's a big question of exclusivity. Buyers always want one-on-one negotiations and to have exclusivity. But sellers often prefer an auction and will have more leverage in price and terms if they go an auction. But for some sellers, sometimes the highest price takes a back seat to other priorities. Maybe you're a PE fund that has a year-end mandate to divest all your portfolio assets. So risk of execution, lowering the risk of execution and having speed to close is more important. So that might prompt you to provide provide a buyer with exclusivity. Sellers usually prefer a well-capitalized buyer and one who can obtain financing. Sellers also prefer buyers who are all in with regard to the due diligence spending. So a buyer with exclusivity is more likely to be engaged and spend the time and the effort to go through this process and spend money. And then finally, at the bottom here, participation and upside of the combined company. In a larger transaction, if the buyer's making an exchange offer or it's a merger where some of the value gets shared with the seller, because the buyer is issuing shares in their company, the sellers might be more willing to accept the buyer's stock if they believe that they can participate meaningfully in synergies with the buyer. So in the middle here, I've just kind of covered the form of consideration. Cash versus stock. But in the wings of the slide here, there's also the choice of deal structure, and that's another major driver of value. So basically, when you're doing an M&A deal, you have a choice. You can either buy the assets of a business or you can buy the stock of the business. Buying assets is the clear preference of the buyer. You basically get a step up in the basis, and I'm talking about book taxes here, I'm talking about tax accounting here, not book taxes and GAAP. But as far as your tax accounting, you get a step up in basis of assets when you buy assets. You also get to record goodwill and amortize it over 15 years. And both of these things, lead to cash tax benefits. You also get to select the liabilities you want and leave the other behind. And on the other side, for the seller, they usually prefer a stock deal. You as a seller are going to have lower taxes if you sell stock. If you're a C Corp, you get long-term capital gains tax treatment and you avoid double taxation. Obviously, you don't have any residual liabilities to deal with that the seller left behind in an asset deal. And it's faster to close. Asset deals take longer. And then there's kind of this middle ground where buyers sometimes will do a stock deal if they can get the seller to agree to a 338(h)(10) election. So basically, it gives the acquirer the ability to get asset sale tax treatment while satisfying the seller's desire to sell stock. You're still burdened with the assets and liabilities of a stock deal, but you can achieve favorable tax treatment of an asset deal with this 338(h)(10) election. Is how I'm doing on time here, Art. I just have another couple comments, and then I think we can move to Q&A.
Okay.
So let's go to the next slide here. So this is my governance slide. These are the board's considerations. So, what are the best practices when it comes to the board? You want to discuss your M&A pipeline and your CapEx roadmap at each board meeting. The board obviously wants to choose the most strategic deals and investments that create the most shareholder value. And then alignment. You want to weigh the risks and opportunities of the deal across the entire enterprise. You can't just focus on the M&A deal and all the lovely things going to bring to you, but you have to understand how it's all going to sync with your your existing business and how that's going to get integrated and drive value together. And then finally is execute, organize the best internal and external resources to achieve the objective. And that's where, I go back to, how you might select an investment banker or advisors and internal team members. This I won't spend a whole lot of time on, but these are some highlights of deals that I've worked on over the year. Obviously, the Marriott Starwood merger. That was a merger, and it was a stock and cash deal, mostly stock. Then a couple of other asset purchases that were key for Marriott were the Gaylord Hotels acquisition, the Protea Hotels acquisition. For Choice, a recent one that I advised them on was Radisson Hotels Americas. That's an interesting one because they were actually acquired by a Chinese company called HNA, and then HNA sold the business to another Chinese entity called Jingjiang. Well, another regulatory consideration in M&A is CFIUS, and CFIUS basically required Jingjiang to divest of its U.S. assets, and that created a fantastic opportunity for Choice to buy an asset-light business. The broader Radisson Hotels company includes a lot of leases in Europe and a much bigger company abroad. But the asset-light business, which is a pure franchise business in North America, was made available to Choice, and they were able to buy that over 600 properties for $675 million on an asset-light basis. Another key deal for Choice was the acquisition of Woodspring Suites. That was an all-cash deal. I mentioned the Greenbrier Resort, which the Justice Family Group ultimately acquired in a stock purchase deal. Even after Marriott had signed purchase and sale agreement for the bankrupt assets of the resort. I think one of the interesting things about Gaylord was they were a public company that owned a lot of real estate. So they actually converted themselves to a REIT, but they wanted to be out of the hotel management business. So they just became a pure REIT, and they sold the brands and the management agreements to Marriott in an asset deal. And I think that's all I'll say, Art, just to give us a little bit of time.
Okay, Jim. We'll open it up to Q&A. I saw Greg Garland was out in front on questions. So, Greg, you want to get us started?
Yeah, thank you, Jim. Excellent presentation, very detailed. I loved it. On the slide, I think it was 5 or 6, was the pipeline/funnel graphic on it. You mentioned economic moat was a term I wanted you to kind of give us a working definition for, maybe an example, and then more valuable might be what are the first top 3 red flags you see that disqualify management teams and can kill a deal opportunity?
Yeah, it's interesting. There's a lot of considerations around the management team, and it kind of depends on whether you're going to keep the management team or not. If you have some kind of a tuck-in where you're basically going to buy the company's operations, their brands, and management's going to go away, that's maybe less of a concern. You mean you've done your diligence, you're comfortable with the business and the assets and the growth, and you're basically just going to fold it into your organization, integrate it. That's one consideration. Another consideration, though, is this notion of converting an entrepreneur into an employee. So I've seen a lot of companies, a lot of, young and high growth companies that are, started by founders or charismatic leaders, really the entrepreneurs who built the business. They have a wonderful business. And then you buy them and you need them to stick around in order to drive value. It is rare, I think, that an entrepreneur becomes and makes an easy transition to becoming an employee. I would say it happens. I'm aware of several that worked out, but there was definitely a transition phase. But other deals have fallen apart on that very issue because we just could not get aligned with the CEO and probably CEO and majority shareholder. So that's what I'd say about the management team and sort of a red flag. Economic mode, it really comes down to competitive advantage and a company that has significant brand or know-how or contracts in place that make it hard for another company to compete and take their market share. So I'd say economic mode is really about your ability to maintain and increase your market share.
Got it. Great. Thank you.
Libby had a question in the chat box. Libby, if you're still here, do you want to ask it?
Yes. Hi. Thank you, Jim. Excellent presentation. With regards to selling a company, if the seller wants to prevent employees from jumping ship before the transaction is all done, what are you seeing out there that sellers do to prevent that, right? Because oftentimes when lower employees or even middle management learns of a company that's going to be sold, they might be looking for opportunities elsewhere, but you need them to stay on board before the transaction, especially if they bring significant value. What are you seeing out there in terms of how is that prevented, or what helps the seller?
Well, I'll start with senior leaders and let's say line leaders. I think there's this structure, that's in employment agreements that will trigger the vesting of options and restricted stock units. So if management has a single trigger, which basically means it accelerates the vesting of their options and stock units simply by the company being put up for sale, that's a challenge. The buyers struggle with that because they need those key people, those key leaders to stay in place. So more and more, I think companies are structuring their comp packages with these double triggers. So the acceleration will be triggered on two events: one, that the company is acquired, and two, that the employee is terminated involuntarily. So that helps. But you're right. It's I think first of all, just as a seller, just keeping the deal under wraps and continuing to operate the business without tipping off many people that the company is for sale, because then they'll start to check out. And then you just have to identify key employees with the buyer and structure some kind of retention bonuses with them.
Great, thank you.
Lubin had a question too about breakup fees. If you're still on, Lubin, you want to ask it?
Yes, not only about the breakaway fees. So question number one, why quality of earnings instead of full-blown valuation? I mean, in terms of quality of earnings, work involved and costs involved, it's not far at all from the fair value valuation, at least. So what do you think prompts people to keep using quality of earnings?
So your question is about breakup fees?
No, that was my second question. My first question is about the quality of earnings in the preparation of transactions. So quality of earnings, if you look at what's involved in preparing the quality of earnings report, it's not too much lighter in terms of work pool than a full-blown valuation of business, arriving at fair value, yeah, by an appraiser. So what makes people still go for quality of earning instead of valuation report?
Well, they're two separate things. You basically have both. So the first thing I'll say about quality of earnings is that as a seller, you might actually pay for a quality of earnings report if you're going to try to help a series of buyers do their due diligence and ramp up on the valuation. Sometimes a seller won't do the quality of earnings. Sometimes the buyer will, I mean, I think the buyer will do a quality of earnings assessment in any case, but sometimes they don't have the benefit of the seller's quality of earnings. And that basically just gives you the raw materials to come up with an EBITDA number. So the quality of earnings really gives you more confidence in your cash flows. It helps you project your revenue and your expenses and your adjustments to get down to this kind of normalized EBITDA number. So that's step one, and that's where the quality of earnings comes in. The valuation takes that that set of cash flows and either runs it through a discounted cash flow model or applies like an industry specific EBITDA multiple to the EBITDA number to come up with the price. So the quality of earnings is really about getting comfortable with the economics of the business and the projected cash flows. The valuation is about coming up with how much do we think this is worth.
No, understood. But the quote again, the valuation report includes basically, if you look at the processes and procedures you're going through to arrive at the quality of earnings, that's probably the biggest chunk of the valuation report. So, and in terms of money, the cost of quality of earnings is not much cheaper than the valuation report. Plus, if you're a seller, wouldn't you be more kind of fighting on the front foot if you have valuation, an official valuation by accredited assessor to argue your end of the bargain with the buyer?
Yeah, I mean,
So the
it's a
question-
fair question. It's a fair question. I would say that most buyers that I've been associated with will do their own independent valuation, regardless of what a seller puts in front of them. Sellers are, from the buyer's perspective, you can count on sellers for putting together very aggressive 3 to 5 year cash flow projections. That's just part of the dance. And you as the buyer need to go in and do your due diligence and do your quality of earnings report to get comfortable with the reasonableness of the cash flows. And you'll probably take some discount to their growth projections. Projections. You might take some discount to their pricing. You might boost some of their costs because they might have pulled out a lot of costs in getting it ready for sale, but you know that it's going to need 10% more costs to really run it effectively. So buyers will do their own assessment and their own valuation. The quality of earnings really is just about getting the buyer comfortable with the cash flow projections.
Yeah, okay. Now, breakaway fees, what do you see, like, in terms of recent trend? What can the seller expect as a breakaway? Well, it could be mutual, actually. In terms of breakaway fees for transactions that are executed on some kind of exclusivity basis.
I think the range of breakup fees is maybe 3 to 5% of the transaction value.
3 to 5, okay.
Yeah. One interesting deal, which is completely public. I mean, this is a current ongoing deal that you might have seen. So my old employer, Choice Hotels, has made an offer for Wyndham, and they were engaged with the seller over the summer and were close to finalizing transaction, but the seller, Wyndham, basically backed away. And now, because Choice is so confident of the strategic rationale of this combination, they are taking this directly to the shareholders. And one interesting thing that I've seen is that they are actually offering a reverse breakup fee. They're so confident that this deal will be approved by shareholders, and they feel very confident with their their ability to get FTC approval, that they're actually providing a reverse breakup fee. I think it's about 6% of the transaction value to the Wyndham shareholders, which is, I've not seen that before.
Thanks.
Libby had another question. Libby, do you want to ask it?
Yes, thank you. Hi, Jim, again. With regards to the TSA, the Transition Services Agreement, what are you seeing in terms of who pays for that? Is it typically the buyer that you see offering to pay the seller for some sort of transition services agreement for a period of, say, 6 months? Is that kind
Yes.
of the process? Okay.
Yeah. So you're basically paying some fee to the seller to, and again, this is more of a carve out type of a situation. I mean, obviously, if you're merging and buying a whole company, then there's no transition service. But if you're buying an asset, buying a carved out business from a seller, there's a lot of pieces that you're trying to extract out of the heart of that business that has all kinds of tentacles, and you have to make sure that you give it enough time to transition over to the buyer in an orderly fashion. And so you actually negotiate a transition services agreement where the buyer will pay, like an hourly fee or, some fee schedule to the seller in order to continue providing those services for a period of time.
No, yeah, that makes a lot of sense. I deal with much smaller business sales along with the real estate, and I see the requests from buyers that tend to be private equity firms asking for, hey, can the seller stay on board for a period of months to help us in that transition? So I wasn't sure if it was a standard practice to ask for a fee from the buyer, but to me, it just made sense. Well, if you want the seller to stay on board for a number of months, then there's got to be a fee involved, to compensate the seller for the commitment of the time that would take to help them out. So, thank you.
Ron Peterson, you have a question if you're still on?
Yeah, I'm still on. Jim, thank you very much for the presentation. Jim, I read that 70 to 90% of M&A fails. And I've also noticed that the emphasis is on the financial and the risk due diligence. Nobody's ever looking at the culture. And that's where the whole thing goes wrong. Why isn't there a cultural due diligence?
That is an excellent question. I have seen deals that have fallen apart after closing. because of a mismatch in culture. I'm actually familiar with one because of my wife who worked at a company. It was a company of maybe 500 people. They were acquired by a public company that was thousands of people. The cultures were just significantly different. Um, and my wife's company was a people business, and I mean they were really just buying the people of the business. And there was no other assets. There was no real brand. There's no real key long-term contracts. It was really a classic services business where the assets ride the elevators at night. And they did such a poor job integrating my wife's company. There was such a mismatch of the culture. Within 2 or 3 years, 2/3 of the employees of the target company were gone. It was a case study in how not to do an M&A deal and how not to do an integration. So I think that's actually, if I do this presentation again, I think I'm going to take your point and add some points on here about the importance of culture. And I would say that is definitely a consideration when we've gone through due diligence. It starts, it really starts at the management presentation. You will get a sense, just body language, of how the CEO. I've been in management presentations where, you can really see that the management team and the CEO are collaborative, and you can feel a respect among the management team. I've seen others where the CEO is just such a strong personality. You can see that everybody in the room is kind of deferring to the CEO and a little bit nervous about what we're going to say. I mean, that's the culture of your organization. Maybe that's what you're looking for. The culture of the teams that I worked on were much more collaborative, and there was a tremendous amount of respect, for leaders by the CEO. And that was a red flag for us when we saw the body language in a management presentation or other pieces of diligence. That was a concern for us.
Thank you.
Greg, you had another question?
Yes, actually, I was looking at Ron Peterson's comment or read it and saw I agree. But the other side of that same coin is which firms are out there doing post-merger integration excellently well, and what are they doing different than all the rest that don't hit that 70 to 90% failure rate?
Yeah, I mean, not to kind of talk my own book, but Choice has been, I'd say, an exceptional acquirer. They've done, in the last 5 years, they've done several transactions that have been very carefully integrated. Again, the culture of Choice is very collaborative. And I think that goes a long way in welcoming, the target company employees. Also, there's just a lot of careful handover and integration that needs to take place for an M&A deal to be successful. I mean, even the technology, there's a lot of things that can, that up here at the top, Marriott and Starwood, that has turned out to be a fantastic marriage of the two largest companies of the day in the industry. And but it wasn't without its hiccups. There was definitely a cultural difference there that ended up being a strength. So Starwood was kind of an upstart in its day. It was edgy. It had it was innovative. And Marriott is this classic, tried and true executor. And so Starwood was, had this very innovative culture, and I'd say, much more nimble than Marriott was. Marriott was much more kind of, good at getting things done, and kind of in a no nonsense fashion. But it really ended up benefiting it. I would say there were some bumps along the way in integration, but at the end of the day, it really worked out to the benefit of both companies, because you had, Marriott was was really strong in corporate groups, and Starwood was really great with leisure travelers with their boutique brands. And so being able to bring the best of both companies together in one has worked out, in the long term. But they're both very complex organizations, and you couldn't expect that everything would be completely smooth. There was a little bit, there was some bumpiness when they tried to integrate their loyalty program, which some of you might remember if you were SPG members or Marriott members. Yeah.
So was it the fact that the deal teams and the integration teams actually knew of each other and can access and have conversations? Because it seems like third parties involved make that risk go up and the failures go up. But you're citing Choice Hotels as an exemplar of how to do it right.
Yeah, I think in the deals that I've been involved with there, and just comparing and contrasting that with Starwood, the Starwood deal by Marriott was done in a very short period of time. They were coming up against pressure against their stock price, honestly. I mean, they fired their CEO and said, "Hey, we're ready to sell this company." Obviously, you can imagine what that did to the internal culture, and so when we had weeks, not months, of diligence. At the end of 2015, we had maybe 6 weeks of diligence, maybe even less. So it was a very fast marriage of two of the industry's largest companies. The Radisson acquisition by Choice and the Woodspring acquisition by Choice, they were much longer processes. We did have outside advisors who were extremely, helpful to us in, navigating the relationship with the seller and with their banker. So I'd say that those outside advisors were definitely beneficial. I think that the integration piece, which is something I usually move on to the next deal when something closes, and then the operating team kind of takes it and integrates it into the company. So I don't have as much experience on the integration side, but there was a very large and deliberate team that integrated both of these acquisitions, the Radisson and the Woodspring suites. Regular meetings, a lot of carefully choreographed work streams to bring these companies on board. I mean, you'd have a dozen different functions on the room in each integration meeting, which was a couple times a week. You need to talk about IT, you need to talk about sales, you need to talk about loyalty, you need to talk about real estate. So you have to, and it's it definitely takes time and some mind share to do that. So people will have to do their day jobs and also step up and handle the the integration of this new company. So it can be stressful. I mean, I think any integration that I've been on a deal where there was an integration, I've participated a little bit on the integration side, but I know for our operating teams, it's always a heavy lift. It's always you're doing your day job plus a lot more to bring on this new company and integrate it into yours. But it doesn't last forever. It can last a few years. I think Choice was able to integrate Radisson over like an 11-month period. It was significantly less than what they anticipated it would. And I think it helped that they had Woodspring and some other things under their belt.
Excellent. Thank you.
Ryan had a question.
Yes, and thanks, Jim. I appreciate the presentation. Was just curious if you could elaborate a little bit more on cost of capital. So understand your point that it's an important threshold. Was just curious, how are businesses in practice arriving at that number? Are they actually applying the capital asset pricing model? And if so, how are you seeing these businesses adjust to kind of the new rate environment? Just curious how that's changing things.
Yeah, great question. So I would say the classic, CAPM model is used in practice, probably with some adjustments to come up with your WACC. What I've done in most of these situations is I have made adjustments to the cost of capital. So you can basically take your entire company WACC, and you can split it up into different WACCs. You can do like a weighted average cost of your different business models. So maybe you have a franchise business over here and a hotel management business here, and then you have owned real estate over here. Well, each of them have different capital implications and different risks, and different downside. So you might give yourself a lower cost of capital. If you split that whole thing up, you might give your real estate a higher cost of capital, and you might give your franchise business a lower cost of capital, because it's just, the volatility of that franchise stream is so much less than the bottom line of a hotel NOI, right? So yes, I would say that the CAPM does play a role. In terms of risk adjusting it, if I look over to, like, say, an IRR analysis, if I'm looking at 10 years of cash flows for a company that looks a lot like me, it's pretty steady, cash flows are pretty reliable, I might only take a 200 basis point premium on my WACC, just to invest with a margin of safety and give myself some downside protection. I want some buffer over my WACC. So, I mean, the classic business school example is accept any deal that's $1 of NPV over, you're using your WACC as your discount rate. But, we wanted a margin of safety and, some cushion. So we, even if it was another business that looked like us and it was a kind of a steady, secure business with, steady cash flows, we would probably still require 200 or 300 basis points of premium over our WACC. Then if we were looking at something that was small or something international or something that had high growth, but the brand wasn't that strong, then we instead of looking at, say, a 10 or 12% cost, we might be looking at an IRR of maybe 14 or 16%. So that's kind of how we would get our minds around the risk adjustment part of it. And in terms of kind of current capital markets and how things have changed over the years, back in, I guess it was 2017, when the tax cuts, the significant corporate tax changes happened under the Trump administration. There was definitely a change in methodology. Not so much of risk, but just in terminal value. I saw terminal values go up meaningfully. And maybe, let's say you would put a terminal value of 10 times on a business at the end of your 10 years of cash flows. That might have gone up to 11 or 12 times just because of the tax changes that were embedded. I think it's always an art more than a science when it comes to current rates. I mean, we've just been in this low rate environment for so long, and that did pull down the cost of capital for folks. But even several years ago, I saw people starting to say, well, yeah, I know that the 10-year treasury is like 1% right now, but I can't bake that into a business that I'm going to own for the next 30 years. At some point, there's going to be a normalization of treasury rates to some reversion to the mean. So when I build up my cost of capital, I'm going to use a normalized 10-year treasury of 4%, not what's currently in the marketplace. So I mean, that's how I tend to think. some people, you know, are probably a little bit more, well, we're going to size our cost of capital to exactly what, you know, the 10-year is now, but I'm buying a business that I'm going to hold for 30 years. So, you know, I want a long-term view of my cost of capital, not necessarily what treasuries are doing right now, because there's a rate cycle, right? And so they're going to come back at some point, and they did.
Hey, Jim, we've got two more questions in the chat box, and then we're going to wrap up the meeting. And we've got about 5 minutes left on how long we can record. James had a question. How do you vet future revenue and cash flow forecasts when doing due diligence? Most of the time, they're much higher than reality and at times hard to validate.
100% agree. You know, you will get, I mean, the facts that you have live in the financials, you know, the audited financial statements, and in the contracts that are signed. You know, you can diligence existing agreements that might have a 20-year term that, you know, are giving you a long-term fee stream. But you know, you will get projections from the seller that says, hey, you know, we're going to grow this business like crazy. You know, we're going to look at 20% growth for the next 3 years, and we want you to pay us on that basis. That is probably the biggest area of negotiation that I've encountered. You know, you can get your mind around what the current business is and what, you know, what's the, you know, the current set of business units and pricing. But then there's this negotiation that you have. You believe there is some growth, but it's almost always going to be lower than what the seller is pitching to you. So, you know, you have to do your own. I mean, you're buying a business in an industry where you have expertise. So you can size up their projections, say there's no way they're going to get all those properties under construction in the next 2 years. Maybe they'll get 50% under construction. I'm not going to pay for all of them. You know, maybe for pipeline, I'll pay 9% value for a hotel that has a franchise agreement that's under construction right now, and I know it's going to open. But what am I willing to pay for just an agreement that's signed and hasn't even started construction yet? And then what do I do with these other things that are in the pipeline where they've had conversations in the marketplace and they're, you know, they're close to signing a contract with a developer, but you know, I'm not willing to pay much for that kind of pipeline. I'm willing to pay for what's contracted and what's kind of you know, already gone vertical on the construction side. You know, I'm in that business. I know that business, and regardless of what projections the seller throws at me, I have you know, my team has the wherewithal to throw reality at it.
Yeah, thanks, Jim. Yeah, this is James. One of the things that I've recently experienced was a very rosy picture and forecast. And through the due diligence, it was very hard to vet. We were able to talk to they only had one customer. It was a company that we did an asset purchase on. And, you know, I did discount, you know, some of it to say, okay, you know, we've got to come up with some level of discounting so that we don't get ourselves too far over our skis. But the problem then becomes, you know, you come to what you think is reality, and then reality doesn't materialize to the tune of, say, 50%. And the ripple effect is that when you try to transact that to your books, and then you have the audit come in next year saying, well, you know, you've got an impairment now because, you know, you got 50% of what you thought you were on those cash flows. And then you get this whole accounting, you know, Pandora's box that opens up. So those are the things that I have found to be the most difficult to deal with.
Yeah, that's definitely a consideration, especially if you're public, you know, and you're concerned with GAAP EPS. So the last thing you want to do is find yourself with a goodwill impairment. And that goes back to the diligence. You're absolutely right. I mean, the the goodwill is often going to come from, you know, the growth, from the valuation that you're paying over and above, you know, the assets that live on the balance sheet, the hard assets. So you have to diligence that that growth. And there again, if you're a financial buyer, I think it's harder. If you're a strategic buyer and you're buying a smaller company, it's easier to do a good job on you know, sizing the purchase price. I mean, at the end of the day, it depends how bad you want it. I mean, if you're going to break down over you know, yeah, goodwill, then maybe it, you know, it speaks to whether you really, you know, whether you really think you have long-term value or not. But I mean, if you're confident in the opportunity and confident that the price you're paid reflects the business and the real growth, you know, then you know, you have less issues with the goodwill. But you know, then you have foreign operations too, where there's FX risks. I've got really close. I've gotten within whiskers of an impairment because you know, the business was doing pretty well, but the FX rate went against us, and we were close to having to take an impairment on that.
Yeah. All right. Thank you, Jim.
Jim, last question. We've got a couple of minutes to answer it. It's from Ira. Do you have any advice concerning customer diligence? I ask because I worked for a company that acquired another company and created a new division out of the acquired company. Only after the acquisition was completed did the acquiring company discover that the customers of the acquired company actually hated the acquired company and wanted to run away screaming.
Yeah, that's a delicate one, because a seller, again, if you haven't gotten across the finish line and signed the ink, it's one of these last pieces of diligence that the seller may open up to you. You know, when you start poking around a target company's customers, it's super sensitive. And but you know, it's also important for the buyer to be comfortable with as well. So typically in our business, I think it's been really more about diligencing the actual customer contracts, and not necessarily going and meeting with customers. So yeah, I'm not sure I understood exactly the scenario that played out there with the question, but
so that it wasn't related to the business that you've been involved in, right? So it was a defense contractor that acquired another defense contractor. And so, you know, after they acquired the other company, they found out in talking to the customers that the customers really were very unhappy with the management of the company that had been acquired. And so now the company that did the acquiring was having to deal with these issues of very unhappy customers that they had inherited when they bought the other company, and you know, trying to salvage that business because they paid a lot of money to buy this other defense contractor, and now all of a sudden there's a question of, well, you know, are all these customers going to go away? And that was the whole basis for the acquisition.
yeah,
right? Because
yeah.
once those contracts were over, the customers would not want to re-up, right? They wouldn't want to give you their business again.
So I'm wondering if the buyer actually had an awareness that they were hated by those customers. I mean, it sounds like they were in the industry, and not sure why the customers kind of turned against the buyer. They seemed like they were happy with the seller, but kind of turned against the buyer. Maybe it sounds like they're in the same industry. So I wonder if the seller was aware that.
Can I sort of just interject here? Sorry, hi. My name is Mayur. I'm from Chicago. We've had some experience, my previous role in doing commercial diligence, because the nature of those client relationships are so important in logistics. It's all a people business, and you're buying the relationships, period, right? You're not putting your product on a shelf. How we did it, we engaged Bain. Bain runs a very good practice in commercial excellence, right? And Therefore, they also can support commercial diligence. One of the things they do is they'll go in as mystery shoppers and at the behest of the seller company. So it's they sell it as, okay, we've been engaged by your vendor to come and talk to you and to give you a survey. And so they'll do this kind of survey when some of the clients can be kept anonymous as long as the seller wishes to keep them anonymous. And in principle, they will be kept anonymous until a certain point in the transaction that you reach that both parties, they may not have agreed on the final price, but they know that, hey, you know, we're doing this transaction. We need to have some openness on who these customers are. And then at some point, before the deal is closed, you're going to find out as a buyer who the customers are. You can never, in a logistics transaction, go into an acquisition and not know which customers you're buying. So at some point within that industry, you're going to know who the customers are, and you're going to get results of this mystery shopping surveys, and it's very detailed analysis that they do in terms of what the status of those relationships are, what's missing, what could enhance the customer experience further. So Bain is a very good one. They don't come cheap, but they do a really good commercial diligence. And of course, the seller has to sign off on it. But as the buyer, you can propose that to the seller and say, hey, you know, they can come representing you to those clients, not the buyer. And generally, we've never ever had a situation where the seller refused that, because at the end of the day, whether they do the transaction or not, they're going to get the details anyway of the results of that Bain study. And if they don't do the transaction, they're going to learn how to better their client relationships at the end as well.
Thank you.
Well, folks, that's it. We have gone quite a bit over the planned time, but this was an excellent presentation with very good questions and answers in the follow-up to the pitch itself. Jim, we thank you for a great job. And folks, once again, reach out to Jim if you want to get the slides. This recording will be sent to everybody by headquarters, and it will be posted on the website, the FANG website, for a period of time as well. Thanks again.